Let's start things off, though, with JPMorgan. The company posted a beat on earnings and revenue, but CEO Jamie Dimon warned of further economic uncertainty ahead as the Fed continues its rate hike cycle. And there you're taking a look at some of the actuals versus the estimates. Beat on top and bottom, but what I was looking through here with regard to what the company was saying and what JPMorgan and the CEO and the leadership particularly are pointing out at this time, really looking across some of the businesses, and it's really coming back to the extent of the recession that they're modeling for. And we've heard everything in how CEO Jamie Dimon has classified this in the past to using the hurricane analogy. And then even now looking like they're anticipating more of a mild recession. And so that is something that they're going to be modeling for in the near term. And of course, it ranges across some of their businesses. But again, just coming back to the quantitative tightening that they're citing here, unprecedented quantitative tightening is what they had pointed to here, Jamie Dimon saying in a statement there. And then additionally, they're still looking at some of the headwinds coming from geopolitical tensions as well, including the war in Ukraine, plus the vulnerable state of energy and food supplies. So net, they're kind of looking at some of the macroeconomic conditions and saying we're not out of the woods just yet, and not even close to it, really.
Yeah, no, Brad, I'm glad you brought that up because it is, it's not, we shouldn't be downplaying this. I have not seen in the past 7 or 8 years, or maybe even going back to the great financial crisis, JPMorgan step up here on earnings day and in the bottom of the, or I would say midway through the earnings release, say their central case, or as they say on Wall Street, their base case for this year is a mild recession. That means they are planning their business under the assumption that growth worsens from the fourth quarter and we see contraction in growth at some point this year, maybe in the first half, unclear what they're looking for in the second half. That is a major red flag, I would say, for a lot of other companies and how things may shape up this earnings season. I think it's playing a large part on driving the shares under pressure here in the pre-market. And then in addition, we've been really hearing over the past 2-3 weeks a lot of these investment banking layoffs that are now starting to sweep Wall Street. And you look at JPMorgan, investment banking sales down, volume sales down 57%. That is another jarring year-over-year decline, follows a decline in the third quarter, in large part because the market slowed down. You have rising interest rates, deals are being put off, whatever it is. This was not a typical, I would argue, not a typical rosy or upbeat JPMorgan earnings day.
Okay, and then just one more thing I got to say about JPMorgan as we see the stock down. It seems to be because of the forecast for net interest income. That seems to be what's to blame perhaps for the decline. Listen, all these guys are going to talk about what's going on in the broader economy. The stock doesn't necessarily usually move because of the macro comments they made. Sometimes it does to some extent, but they're saying for that net interest income will be about $73 billion this year. Estimates were for $74.4 billion. So that in a rising interest rate environment, to see that net interest income forecast fall below what analysts were anticipating, that should give folks pause. Let's talk about Bank of America as well, because we got a lot to get through this morning. Their net interest income in the past quarter was up by 29% to $14.7 billion. That, however, was a little bit short of what analysts had been predicting. Trading revenue helped make up for some of that shortfall in net interest income. It was up 27% to about $3.72 billion. In particular, fixed income for Bank of America performed well. It was up by 49% in terms of the revenue. Investment banking revenue was down by 54%. We're going to see investment banking really get hit probably at a lot of the banks. They're seeing lower fees from things like mergers and acquisitions, for example, and underwriting as well. So that's something to keep in mind. Now, CEO Brian Moynihan did strike an upbeat tone in their statement. Their conference call is not for another 25 minutes. So if he makes any more pessimistic comments on the economy, we'll have to wait until then. But he did talk about ending the year on a strong note. The themes in the quarter have been consistent all year: organic growth and rates helping deliver the value of our deposit franchise. A couple other things to mention when we I know we're closely watching headcount and potential job reductions at the banks. It sounds like that is not in the cards for Bank of America, at least not at any large scale. The company's CFO, Alistair Borthwick, saying the company has no plans for massive job cuts. And indeed, if you look at their headcount numbers, you'll see that they didn't see any reductions. In fact, they grew overall headcount above 216,000 in the quarter. They had 208,000 folks a year earlier. So those are some of the headlines and highlights that I am watching right now, you guys, from Bank of America.
And that's what you get from Brian Moynihan and Bank of America, guys, a really well-run bank and not having to do a lot of layoffs. But switching gears for me, I'm monitoring Wells Fargo here. The bank, I think in some of the early commentary I've seen out there, everyone, getting some high marks for the charge-offs or litigation-related expenses. That looks to be slowing down compared to prior quarters, which is interesting to see. Of course, Wells Fargo has been battling various legal issues for some time, and Charlie Scharf, the CEO of the company, has had to come in there really, and it's been hard for him to orchestrate any turnaround plan because he has had to deal with these legacy issues. So that reversal or that trend improvement, which may be beginning in the first half of this year on litigation reserves, is very important. And then, we were just talking about JPMorgan calling out a mild recession this year. I hopped on a media call this morning with Wells Fargo CFO Mike Santomassimo. He did tell me that he's preparing for the economy to get worse over the next couple quarters compared to the prior few quarters. You have JPMorgan calling out a base case of a central recession. You have Wells Fargo CFO looking for the economy to worsen. And wow, guys, this is definitely, I would say, a change in tone from some of these banks, excluding Bank of America, like you mentioned, Julie, but a change in tone by some big banks to kick off this earnings season.
Yeah, definitely. So I'm looking at the tone coming over at Citigroup. The CEO, Jane Fraser, there saying, "We intentionally designed a strategy that can deliver for our shareholders in different environments, and we are very much on track to reach the medium-term return targets we shared on Investor Day," she says. If you look at the numbers here from the bank, you see earnings per share missing by a little bit, and in particular, revenue from equities trading falling short of analyst expectations, fixed income trading revenue, however, topping estimates. So that's something to watch as well. Investment banking revenue here, another decline for these banks that were pretty much going to probably see across the board, down 58% in the case of Bank of America. That revenue figure we just showed of about $18 billion was a 5.8% increase on a year-over-year basis. So those are some of the themes that we are watching from Citigroup. Those shares are little change, just down about a tenth of 1%, I think we were looking at there for just a sec. We're going to keep looking through all of these as well as keep telling you about the reactions to them, Soz.
Julie, we done with earnings? I'm out of breath here. I can't keep up.
Well, you got to keep up. You of anyone, you're the one keeping up. You're doing great, Soz.